Welcome back to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business, and this video is all about long-term liabilities. There's a lot to cover today, so I want to take things a little bit slowly and make sure we understand the basics. So I'm going to go over some fundamental principles of long-term liabilities, and then the basic accounting for standard debt situations. And then I'm going to talk about some of the more complicated things where we have debts with matching assets and some other miscellaneous obligations, and then the topic of hybrid securities. So let's look at these fundamentals. I want to start with the time value of money, and then I'll talk to you about the cost of borrowing. The time value of money is a really basic concept for understanding debt, and I can explain it by comparing it to interest. So on the left-hand side, you've got a chart that shows interest. You've got $1,000 here being invested in year zero, and over time it grows to almost $2,000. And this is a very simple situation here. It's $1,000, and the interest rate calculation that's being done here is 7%. So with 7% interest, the value of an investment almost doubles in 10 years. Interestingly, if you had a 10% interest, it would almost double in 7 years. So those are two little figures to keep in mind as you're thinking about interest rates. Here you've got time progressing from left to right, and the value of the investment is growing. And discounting is just the opposite situation. Imagine that you had to make a payment of $2,000 in the future. What is the value of that today? So 10 years from now, if you had to make a payment of $2,000, you'd have lots of opportunities to save up for that. So it's not the same as having to pay $2,000 today. How do you calculate that value? Well, we just take the interest calculation and we turn it upside down. So instead of moving from left to right through time, we work backwards from that future date to come up with a value. So if you have a payment of $2,000 that is due in 10 years and you discount it at 7%, you're going to come out with a figure of approximately $1,000. The basic contrast we're making here is between interest and discounting. With interest, the idea is you invest money today and you're trying to figure out what is it going to be worth at some date in the future. With discounting, you're either going to receive or pay money at some date in the future. What is it worth today? And so you're just working backwards in time. The idea of discounting is really important in debt situations, particularly for notes payable, for bonds, and for pension plans. And I'll show you how that works when we get to each of those particular kinds of debt. Comparing interest and discounting. The calculations with interest involve three different variables. The number of periods. In the example we just graphed, it was the number of years, but often you can do this in terms of months. You've got the interest rate per period. And the important thing here is that if your number of periods is in months, you have to convert the annual interest rate to a monthly interest rate. The examples I'm going to give you are all just years. So the number of years and the interest rate per annum. And of course, then you need to know the amount that's invested. The formula that you will need to calculate is basically taking the principal and multiplying it by this formula here, which is 1 plus r to the nth power. So if you think of the example that we graphed, you had $1,000, and in the second year, the interest was 7%, so r was 0.07. That's like taking the $1,000 and multiplying it by 1.07. And then the second year, you multiply it by 1.07 again. And the third year, you multiply it by 1.07 a third time. An easy way to calculate the value in year 3 is going to be take the principal and multiply it by 1.07 cubed, on 1.07 to the third power. So that's a fairly basic calculation that you can do on your calculator. So here's an example. This is $1,000 invested for 3 years, this time at 5%. So it's $1,000 times 1.05 cubed. There's the calculation. And that is the value that you get on your calculator if you were to do it. Discounting, you're working the opposite direction, but the variables are roughly the same. You've got the number of periods, and you've got what's called the discount rate. Now, that's really the same thing as an interest rate, but we call it a discount rate when we're working backwards. And you've got the amount that you are either going to receive or pay at that future point in time. On the left-hand side, the amount invested is the amount that you put in now. With discounting, you've got the future amount that you're trying to work backwards from. Discounting works whether you have to pay that amount in the future or you're going to receive that amount in the future. You can use discounting to figure out what's the effective value of that today. Obviously, that depends on how far away in the future it is. That's the number of periods and the discount rate that you're going to use. We'll talk about how discount rates are chosen in accounting when we get to a later slide. The formula is very similar to the formula on the left, except that instead of multiplication, you're using division. So the present value is that principal amount P divided by 1 plus R to the nth. Here's an example of that. If you have $1,000 that is either to be received or paid in 3 years' time, and you discount it at 5%, you're going to get 1,000 divided by 1.05 cubed, which is $863.84. Now, just to compare here, if we had put an amount equal to $1,157.63 into this formula, the answer that we would have got here would have been exactly 1,000. The second basic concept for long-term liabilities is what I'm calling the cost of borrowing. And what I want to show you here is how tax plays into decisions to borrow or not borrow money. We have a set of assumptions here, and these are the interest rate, the tax rate, the asset turnover rate, the amortization rate, and the gross margin. So what's going on here? The key thing here is this asset turnover. What I've got is an assumption that we have $1 million of equity investment, which has bought us $1 million worth of assets. And with an asset turnover of 1.2, that means for every $1 million worth of assets, we're getting $1.2 million worth of revenue coming in. With a gross margin of 30%, that gives us a cost of goods sold of $840,000, leaving us a gross margin of $360,000. Now, I have assumed in all the scenarios a fixed operating cost of $100,000, just to plug a number in there. But the amortization is going to be generated by the amount of assets that we've got. So in this case, we've got $1 million worth of assets at an amortization rate of 20%, what must mean that we've got amortization expenses of $200,000. Now, there's no interest expense in this scenario because if you look up at the top, we haven't borrowed anything. And that leaves us with a taxable income of $60,000. The calculation is quite simple there. We got a revenue of 1.2 million, cost of goods sold of 840, leaving us gross margin of 360, minus the $100,000 and $200,000 worth of fixed operating costs and amortization, leaves us with taxable income of 60,000. And the tax on that at the tax rate that's specified of 20% is going to be $12,000. So that leaves us with a net income of $48,000. So this is the base scenario that you need to understand in order to play with the other two scenarios I'm going to show you. And they basically take this baseline scenario and add another $500,000 worth of assets. And those $500,000 worth of assets has to be financed in one of two ways, either through equity or through borrowing. So let's see the effect of these things. Here's our second scenario. So this is taking the baseline amount and adding $500,000 worth of new investment, and it's all coming from equity. So this is going to be similar to the scenario on the left, except that we've got more investment and therefore more assets. The asset turnover ratio of 1.2 means that we're going to generate $1.8 million worth of revenue. We've said that our gross margin is 30%, so that is going to give us these two figures. I've said that the fixed operating costs have just been plugged in at 100, so they haven't changed because they are, after all, fixed operating costs. The amortization has gone up a little bit because there are more assets, right? There's $1.5 million worth of assets now based on the investment that we were given. And that leaves us with, again, no interest because we haven't done any borrowing, and taxable income of $140,000. At our tax rate of 20%, that is $28,000 worth of tax, leaving us net income of $112,000. So this makes sense, right? If you've got a baseline scenario with $1 million worth of equity investment and an asset turnover of 1.2, it makes sense to put in another $500,000 worth of equity on the assumption that you can earn the same turnover rate, and you're going to generate more revenue, some higher expenses, but you're going to come out ahead. You're going to increase your income dramatically from $48,000 to $112,000. The effect of all of this is to increase your return on equity. So in this case, you have a 4.8% return on equity, and here you've got a 7.5% return on equity. Why is it higher? Well, because some of your costs are fixed. They don't go up with additional investment. Now let's compare a third scenario. In this third scenario, we want to end up with the same amount of financing as in the second scenario. We're going to end up with 1.5 million compared to the previous scenario. But in this case, the additional investment is going to come from borrowing. We're going to borrow 500,000. So this is going to give us the same revenue, the same cost of goods sold, the same gross margin as in scenario 2. We got the same fixed costs, the same amortization. The only difference here is that we now have $30,000 worth of interest. We borrowed $500,000. Our interest rate is 6%, so we have to pay 6% of the $500,000. That's $30,000. This means that our taxable income is $30,000 lower than in the equity situation. Now, our tax on the taxable income is only 22 because the taxable income was lower. In the previous scenario, it was 28. This leaves us with net income of $88,000 compared to the $112,000 net income that was calculated in the second scenario. So it sounds like this is not a great deal because instead of ending up with $112,000, you end up with only $88,000 worth of net income. But you have to remember that you didn't have to put up all the money. You only put up $1 million to generate this, and you actually borrowed the additional capital required to purchase the new assets. Although the net income has gone down, it's dropped from 112 to 88, the return on equity is actually higher. Look at here. The return on equity is 8.8%. Why is this? Well, because you're generating 88,000 out of a $1 million investment rather than 112,000 from a $1.5 million investment. So the return in percentage terms is actually higher. So how does this work? Well, the thing to keep in mind here is that this $30,000 worth of interest right there is actually deducted before you calculate your taxable income. This means that the taxpayers, the other taxpayers in the jurisdiction in which you're operating, are picking up part of the cost of your borrowing. That interest expense of $30,000 is actually only an after-tax interest of $24,000. That's because your lower taxable income right there generates a $6,000 savings in taxes. So what this means is that you have a tax subsidized interest rate of 4.8% instead of the 6% that the bank is charging. So this is one of the things that makes it worthwhile to borrow money instead of investing your own, is that you get to deduct the cost of interest and let everybody else pick up the cost of borrowing. Now, just for the sake of argument here, or for full clarification, you see this 8.8% return. If you were to borrow the money and the interest expense was not tax deductible, then your return on equity would only be 8.2%, right? That's because right here you would end up with $82,000 worth of profit instead of 88. So this would still generate a higher return on equity than the second scenario, right? That's 7.5%, and 8.2 would be higher than that, but not quite as high as the 8.8%. All of this is to say that borrowing is a great idea as long as one condition holds, and that is that the additional revenue and net income that you can generate is higher than the interest rate. So if the additional assets that you purchase are not going to generate a 6% return, then there's no point in borrowing because you're actually going to come out lower. And this is the effect of leverage. Leverage will amplify good results. So if your good result is that you can generate more than 6%, then borrowing is going to amplify the amount of net income that you can get, and it will amplify the return on equity. But if the return on your assets is lower than the interest rate, lower than 6%, you shouldn't do it because it is going to make the situation worse. All right, so those are all the calculations you need to understand in order to get into the accounting for debts. So let's start to look at that now. Loans and interest. The thing that you need to understand is that interest is accrued as a function of the passage of time, right? So as time goes by, you owe interest whether or not you pay it. So this is an accrual that's done at the end of the accounting period, and we've done that in some of our bookkeeping examples earlier in the course. So this is what's called a period expense because it pertains to the period in which you're doing the calculation. It doesn't have anything to do with a specific revenue event. Okay. So the example of the journal entry here is that you've got a debit to interest expense and a credit to interest payable. Regardless of whether you paid the interest, you have the expense to record on your income statement. The disclosure of the loan on the balance sheet is going to be basically at the value of the remaining principal on the loan that's yet to be paid, plus any interest that has been accrued and is payable. So that's what's going to show up on the balance sheet. And keep in mind, of course, that when you actually get around to paying the interest, it's not an expense because you've already recognized the expense on the income statement. So in this situation, you have a debit to the interest payable and a credit to cash. If you had not accrued the interest previously, it would have been debit to interest expense, credit to cash. But since we already did the accrual for the expense, the debit goes against the payable to wipe out the payable that we set up. So the other thing to keep in mind, of course, is that when you actually repay the principal, that is not an expense. It was not an expense any more than obtaining the loan was revenue. Notes payable, a note is just an IOU. It specifies that an amount has to be paid at some date in the future. The example I'm giving here is $1 million that's due in 3 years' time. This calculation that we're going to show you applies whether you are the person who owes the note or is going to receive the payment in the future. Here I'm going to be considering it from the point of view of the debtor, the person who has to make the payment in the future. So presumably you have received some consideration from a lender and you are going to be paying them $1 million in the future. And in this case, 3 years away. The point here in accounting for a note payable is that you don't show the full $1 million on the balance sheet this year. What is the value of that $1 million that's due in 3 years' time? Well, you have to calculate present value. So you do your discounting calculation. Just as we did before, we've got this calculation of $1 million. In this case, it's 5% interest over 3 years. And we're doing that division, right? So it's $1 million divided by, that's what 1.05 cubed looks like. It's 1.15765. And when you do that calculation, you come out with $863,000 in change. So that's the amount that should be shown on the balance sheet now to disclose the value of $1 million obligation that has to be paid in 3 years' time. Next year, you're going to do a present value calculation again, and you're going to find out the amount has changed because you're only squaring the 1.05. So the 1 plus the 5% interest is 1.05 times itself. So squared, 1.05 squared is 1.1025. And now the division comes up with a larger amount because you're dividing by a smaller amount than before. So the present value has changed. And how do you record the change? Because, of course, this obligation has changed in the liabilities section of the balance sheet. And because the liability has gone up, that's a credit. You need a debit to go somewhere to offset things. So if you do the calculation, the difference between those two numbers is $43,191.88. So that becomes a debit to finance expense, just like an interest expense, say. And you have now interest payable. So the total amount to be disclosed on the loan is the discounted value of $863,837.6 plus an additional $43,191.88 for a total showing on the balance sheet of $907,029.48. So how is that working? We have that original amount that was on the balance sheet. We're going to add to it this amount here, and we're going to end up with that amount showing on the balance sheet as the amount owing. And of course, in the following year, we're going to discount it only by 1.05, and it's going to go up. Eventually, we're going to get to the full $1 million shown on the balance sheet as an amount payable, and then hopefully we're going to have the money to pay that off. So effectively then what you've got is the identical situation to having an $863,000 loan and charging 5% interest on it. Now, those are the basic situations, and as complicated as those calculations might have been, I'm afraid that they were the basic situations. So now I want to talk to you about the idea of having a debt with a matching asset. So it's important to realize that the general purpose of borrowing with a corporation is to acquire assets, right? You're obtaining financing in order to acquire assets. So there's three primary situations that I want to talk to you about. One is mortgages, another is leases, and another is pension plans. Let's go through those in order. Mortgages are just a loan where you make blended payments, an equal blended payment. This is a spreadsheet that you've seen in class when we were talking about different kinds of depreciation. The scenario I'm setting up here is you've got a purchase price for an asset of $1 million. Generally, banks don't like to loan you the whole amount of money, so I'm going to assume that we're going to make a $100,000 down payment. The bank is going to charge us 5%, and we're going to pay it off over 5 years. Now, this is a very simple situation, a very simple scenario where I'm just making 5 annual payments. Most mortgages are monthly, but this cuts down on the number of numbers you have to look at on a slide. But the calculations are the same as you would see if you're doing it monthly. It just involves larger amounts in order to pay it off in 5 lump sums. So what is the amount of the mortgage? Well, it's 900,000, right? Because you had $1 million for the purchase price minus your $100,000 down payment. And if you were to use Excel to calculate what the payment would be at a 5% interest rate in 5 equal payments, you'd realize that the calculation is going to come out to the $207,877. So if you were to make those 5 payments 1 year at a time, you'd end up paying off the loan balance of 900,000 exactly. So the 900,000, the interest on that at 5% was $45,000. You can do that calculation in your head. And that means that there is 162,000 of the $207,000 payment left over to be applied against the principal, leaving us with that balance. The 5% interest on that is 36. That means that there is more left over to pay down the balance. So we're down to 566. The next year, the interest on 566 is lower than the year before, leaving us more to pay off the principal, bringing the principal down to 386,000. And of course, the interest keeps dropping. The amount that's left over out of the $207,000 payment is going up and up and up. And by the time you get to this situation, the interest on $197,000 is just shy of 10,000, leaving us that amount to apply to the balance, and we are done. Okay, so the thing to keep in mind, of course, is that you not only have interest expense, which totals up to $139,000, but you've got an asset that gets depreciated. So here I've set up a simple situation. We're doing straight line depreciation based on $150,000 residual value and an estimated useful life of 8 periods. That gives us $106,000 amortization expenses each year until the book value is drawn down to 150. So it means that we have amortized $850,000. And as we saw when we did this calculation, you have to keep in mind that this is going to be the overall effect on your income statement, right? So that first year is the amortization plus the interest, so it's 151. And each year is a total expense hitting your income statement until the last few years, the loan has been paid off and you only have the $106,000 amortization expenses hitting your income statement. Let's turn our attention to leasing. And I want to compare leasing to 2 other options, which are renting and purchasing. Basic idea of renting, like when you're renting an apartment, is that you have just basically purchased the right to use something. You do not own an apartment when you rent it, but you do have the right to use it as long as you're renting it. And leasing is just a rental agreement, except that you are making a commitment to rent something for an extended period of time. So as long as that period of time is not too long, leasing and renting are exactly the same thing. And you're familiar with this if you have leased an apartment for 6 months or something like that. It guarantees that your rent is not going to go up during the life of the contract. So that's the advantage to you. The advantage to the landlord is that the landlord has someone who is committed to renting it and you don't have to worry about it going vacant. So purchasing something, like purchasing an apartment or purchasing a car or something, you do get ownership of the asset. And typically it involves taking out some kind of a loan, a car loan to buy a car or a mortgage to buy a condo unit. All of this seems very straightforward. Leasing is like renting, isn't it? Well,
The problem is what happens when the length of time extends out to the point where you are basically getting the advantage of the asset for pretty much the entire useful life of that asset. Well, that amounts to what's called off balance sheet financing. Why is that? Well, because if you can lease for almost the entire useful life of an asset, you don't own it, so you don't have the asset on your balance sheet, but also you don't have the loan appearing on your balance sheet, right? You're simply making rent payments. And this is a little bit misleading because you've effectively got the use of the asset for its entire useful life, but there's no loan showing on your liabilities. And therefore, there is no effect on your debt to equity ratio. And again, this is what's called off balance sheet financing, and it's considered a big problem. So, back when WestJet first started out competing with Air Canada, it looked like it was doing very well in terms of its financing because it leased all of its aircraft. Air Canada owned its aircraft and had loans for the purchase of those airplanes. And so Air Canada had a large debt compared to the equity in the company. And WestJet looked like it was flying high because it had virtually no debt shown on the balance sheet, even though they are effectively using the airplanes for the entire useful life of the plane, just like Air Canada was. So the accountants got together and realized that this is a very misleading situation. We need to be able to allow people to compare one airline to another, or one mining company to another, or one printing company to another, and not have to worry about whether the commitment that has been made to use the asset involves a purchase situation with a loan or a long-term rental situation, which is leasing. So that's the problem. What's the solution? The solution to the problem comes from IFRS 16, which covers leases. And this applies to all leases greater than 12 months. So if you are leasing something for less than 12 months, that's just rent, and you record the expense every month as a rent expense. However, if you're leasing something for more than 12 months, you have to do the accounting this way. And the general principle here is that you need to be able to compare one balance sheet to another. And if you got one company that is renting something for more than 12 months, and another company that is buying something and selling it more than 12 months later, the balance sheets need to be comparable because in both cases, you're getting a fairly long-term use of an asset. So what is the asset? What's the justification for doing it this way in IFRS? Well, you've got this intangible thing, this right to use the asset that needs to be taken into account. So that is your asset that's shown on the balance sheet, this right to use asset. It's just disclosed as a truck or an airplane or whatever it is that you're leasing, but that is the justification for it, is that you are purchasing the right to use. And the liability then is this legal obligation to make the payments. And the calculation is actually reasonably straightforward. You need to take each of the lease payments that you've committed to and do that present value calculation that we talked about. A lease payment that is 1 year in the future, you're going to divide it by 1 plus the interest rate. A lease payment that's 2 years in the future, you're going to divide it by 1 plus the interest rate squared, so 1.05 squared, for instance, and calculate the present value of each of those lease payments, and that is going to give you a value. And that value is going to be the value that you set up on the balance sheet for both the asset and the liability. They're going to be identical. Now, once you set those up on the balance sheet, from that point on, they're not going to remain identical because you're going to amortize the asset using some cost model. You know that when we looked at the assets, there were a couple of cost models, including the declining balance method and the period method that spreads the amortization expenses out in an equal amount over the life of the asset. And then there's the liability that you have to deal with, and you've set up the present value of the liability. So each month you're going to accrue interest on it, just like the calculation that we did when we compared the interest and the discounting calculations. So you're going to have a lease payment that gets recorded as if it's a blended loan payment. And each month then, or each period, you're going to end up with an amortization expense and an interest expense. So even though you don't legally own the asset, from an accounting point of view, it's as if you owned it. And you're going to end up with that same situation accounting for leases as we saw for borrowing money and having a mortgage on an asset, where every period you've got an amortization expense and an interest expense until the asset is amortized over the useful life of the asset and the loan the quote unquote loan is paid off by the blended payments that are the lease payment. Conceptually, it's not overly complicated because we've seen each of these pieces before. The conceptual leap here is that accounting is treating these lease payments as if you had purchased the asset and taken out a mortgage. Pension plans are another situation where you've got an asset and a liability that match each other. So how does this arise? First of all, you have to realize that there's two different kinds of pension plans. The simplest one is the defined contribution plan. With a defined contribution plan, the company is basically committing to paying a specified amount or a defined amount now. So every pay period, the company deposits in trust for you a certain amount of money for your pension plan. Of course, this is assuming that you're fortunate enough to have a job that pays you pension benefits. All of those contributions then are held in trust, so you don't get them until you retire. But the important thing is that there's no future obligation for the company. The benefit that you're going to get when you retire is determined by the performance of the investments that are made by the trust company. So if the investments are done well, then you're going to end up with a lot of money in your pension plan and your benefit is going to be high when you retire. If the trust company has not done a good job of investing, or if the economy hasn't done well, then the amount of benefit that you get later on is not going to be as good. What does this mean? It means that when the company makes this defined payment, it is absolved of any future risk. All of the risk is yours. You are the one that gets the bigger or the lower benefit in the future, depending on the way that the investment is made by the trust company. And the company is not on the hook for making up for any shortfall. If it turns out that the benefit that you've got is not enough for you to retire on, that's your problem because you have accepted a defined contribution pension plan. What you have here then is a situation where all of the individual employees are exposed to the market risk, which is something they can't control. With a defined benefit plan, you have a slightly different situation in which the contract, the pension contract, specifies that the employee is going to receive a defined amount in the future. For instance, rather than the contract saying the company must set aside $250 every month to go into your pension plan, that's a defined contribution scenario. What it's saying is that when you retire, you will receive a certain amount of money, let's say $1,500 a month or $2,500 a month or whatever the contract specifies. And that's going to be a function of how much you earn and how long you've been with the company. But it's going to define that regardless of what scenario you are in, it's going to calculate a specific amount that you will receive in the future. So the company then has to estimate using actuaries how much it should set aside in trust in order to satisfy that obligation that it has in the future. What it's going to do then is going to calculate what all those projected pension benefits are going to be, and it's going to discount those to the present value of all of those obligations, and it's going to figure out how much it needs to set aside. So every month it's going to set aside a certain amount, and every month it's going to calculate what the liability is for all of those future pension payments. And on the balance sheet, it's going to show what the difference is between those. So the net asset or the net liability in relation to it's the comparison between all the money that is set aside and the present value of all those future payments that it's going to need to make. That's going to be a net amount that shows on the balance sheet. And the problem with this is mainly on the company's side, right? Is that the company now is the one that's exposed to market risk, which it can't control any more than the individual employees can. But there's additional problems here in that the defined benefit plans are open to a little bit more manipulation by management. And I have some research studies that I've done on that. If you're interested in learning about those, I can tell you about them. And the other problem is that because this net amount has to be disclosed here on the balance sheet, that can change wildly from one year to the next, depending on the present value calculations that are done. So that means that net amount can go up or down substantially. It can switch from an asset to a liability or back and forth from one year to the next, and that plays havoc with the balance sheet of the company. That's a bit of a problem for accounting because the balance sheet then becomes kind of an unreliable indicator of the economic position of the company right now. However, that's only fair because the company has promised to make those payments to the employees in the future, and it is on the hook for those. What did the company receive in exchange for that promise? Well, it received the opportunity to pay the employees less because the employees have agreed to a lower payment of wages now in order to receive the pension obligation. So this is the thing that you have to keep in mind with the defined benefit plan, defined contribution plan. Both of them are what's called deferred compensation. The employees have agreed to take lower wages now in exchange for this benefit that they'll receive in the future. And the laws of the US and Canada and the UK have always recognized that this is deferred compensation. It is something that the company has negotiated and has basically got the right to pay the employees later. So the question then is purely who bears the risk? Is it going to be the individual employees or is it going to be the company? And that's the key difference between the defined contribution plan and the defined benefit plan. Who bears the risk? From an accounting perspective, this creates some problems. You'll recall that I just told you it creates some volatility on the balance sheet. Why is that? Well, because the present value of all those future pension payments depends significantly on the discount rate that's used. Companies are supposed to use a discount rate that is based on high quality corporate bonds. That's actually specified right in IFRS. Now, it doesn't tell you how to go about determining what high quality corporate bonds are. That's something for you to negotiate with the actuaries, but that is going to give you some kind of a discount rate that's equivalent to the amount that you could earn if you were to issue a corporate bond and pay interest payments or buy a corporate bond and receive interest payments for the equivalent obligations in the future. Now, obviously, this is going to change significantly from year to year if the interest rate changes. We've been in a period of fairly low interest rates and fairly stable interest rates over the past 5 or 10 years, but that has not always been the case. So the effect of a change in the yields on high quality corporate bonds is really significant because you have to keep in mind that we've got a really large number of large obligations, right? So a pension plan could involve millions of dollars worth of payments every year to all the retired employees. So here I've sketched out a little scenario where the company very simplistically has to pay $1 million in pension benefits every year for the next 50 years. That means that counting the payment this year, you've got a total cash outflow of $51 million. The amount that is shown on the balance sheet as a pension obligation is going to depend on the discount rate. So here we've got a discount rate of 4%, and that calculates out to a present value of all those $51 million of future cash flows of $22 million. If the yield increases just 1%, that $22 million present value calculation drops to 19. And if it increases to 6%, it drops even further to 16. So every increase in the discount rate is causing a huge impact on the present value of those future cash flows, even though the cash flows themselves have not changed. Let's just look at that payment that's due in year 50. At a 4% discount rate, that $1 million payment in year 50 is in present value only $140,000. At a 5% discount, it's dropped significantly to 87. And at a 6% discount, the present value of that is only 54. So that's where the big change is happening, is in those distant amounts that are being discounted at 4, 5, or 6%. So you can see that the discount rate that's chosen by the company to represent what the yield would be on high quality corporate bonds is going to have a huge impact on the pension obligation. Those were our examples of liabilities that have matching assets. Now let's look at some other obligations, which are quite simple, and I just want to go through those conceptually with you. We're going to talk about provisions, contingencies, commitments, and subsequent events. A provision is an accrual that's made for some uncertain obligation in the future. So something where the amount is not exactly known or the timing of it is uncertain, but you can still estimate what the amount or the timing is going to be. How do you deal with this in accounting terms under IFRS? Well, you should recognize the expense now and accrue a liability. We talked about this a little bit earlier in the course, but the examples would be when you've got a lawsuit that you're likely to lose, You may not know exactly the amount that is going to be awarded, and it may not be 100% certain that you're going to lose the lawsuit, but you can estimate it. You can say, well, we think we've got a 60% chance of losing the lawsuit, and we expect the damages to be between $1 and $1.2 million. So you would accrue a liability that is some midpoint in between those two figures and take 60% of that because you had a 60% expectation of losing. And there's your liability and your expense that are accrued. And of course, each year, if the lawsuit hasn't been settled, you will reevaluate the likelihood of the loss of the lawsuit and the likely damages and update the liability. And that's going to change the expense that is recorded that year by whatever amount the liability changed. Same idea. If you know that you're going to be penalized for some fraudulent activity, then you can estimate what the penalty is likely to be and what the likelihood is of being penalized in that way. And you should accrue the expense. Now, if you are a company that is going to have to clean up after an oil spill like BP, then you can estimate what the cost is going to be and when those costs are going to have to be expended. If you've got coupons and loyalty program points sitting out there, you can make a provision for those, as we saw when we talked about those. So all of those are based on the idea that although this obligation is going to happen in the future, that obligation arises from past events. And that is precisely why these are treated the way that they are. We're recognizing the expense now because they pertain to something that happened in the past, even though the payment is going to come up in the future. So the lawsuit is about something that you did. The regulatory penalty is about something that you did. The cost to clean up the oil spill is about something that you've done now. Even if the oil hasn't spilled, even if it's just the potential of an oil spill, you are drilling now and you are potentially going to have some kind of an oil spill. Cleaning up a mine site. If you're excavating minerals from the mine, you are getting the revenue now and you should match to that the expense of cleaning it up. So this is the matching principle as well coming into play. Contingencies are a financial obligation that depends on a future event, right, as opposed to a provision. So in this case, you are disclosing it in the notes, but you have no way of estimating the value. A lawsuit is something that would fall into this category where you have absolutely no idea of what the outcome is going to be. You can't possibly estimate it. In that case, you would have to just say in the notes, we're subject to litigation on such and such a thing. We don't know what the cost is going to be or what the likelihood is that we're going to win or lose the case. The future event in this case is the decision that's going to be made on the lawsuit. So the difference here between the contingency and the provision is really about whether you can actually predict what the outcome is going to be and make an estimate of that future payment that you're going to have to make. Commitments are simply disclosing to people that you're in a contractual agreement. For instance, you would disclose in the notes whether you've got an agreement with a supplier to make a certain minimum purchase. So this can be this situation where you've agreed to buy, say, ball bearings for the next 3 years. You're not going to accrue anything until the actual shipment arrives and you've got accounts payable. But that is going to be the critical event at which you make the accrual, and then selling those ball bearings or using them in some product is going to be the point where revenue is recognized, and then the value of the inventory is going to flow out onto the income statement as cost of goods sold. But until all of that happens, all you can say is that we have made this commitment to the supplier to make a certain amount of purchases over the next 3 years. There is nothing that you can do to accrue anything because nothing has happened yet. But again, that's something that people want to know because they want to know whether the assets of the company, in this case the cash, are available for other purposes. Subsequent events is not really a liability, but it's just something I like to throw into this section of the course so that you can understand it. There are two kinds of subsequent events. So a subsequent event is something that happens between the fiscal year end and the point of time at which you release the year end statements. So if this event is something that impacts the year end, then you should adjust any of the estimates that you've got in the year-end accruals in order to update them. For instance, in your allowance for doubtful accounts, you may anticipate that a customer is going bankrupt, and so you are trying to calculate what's the likelihood you're not going to get paid. If the customer actually does go bankrupt or changes the situation and comes out healthy and is able to pay you, then you have information after the year end that you can use to make sure that your estimate for the allowance for doubtful accounts is as accurate as possible. Same thing if you make a provision about a lawsuit. Well, if the lawsuit settles, you no longer have to make a provision based on an estimate. You can actually accrue the value of the lawsuit as an expense then, even though the payment won't be made until the date that the lawsuit is settled. But if it happens between the year end and the release of the year end statements, you can provide people with accurate information instead of just a general estimate. Same thing if you are trying to represent the value of some old inventory, you're estimating the net realizable value of it. Well, if you sold it during that intervening period between the year end and the year end statements, you don't have to estimate it anymore. You know exactly what you got on the sale of it. Now, if this is an event that does not impact the year end numbers, but is something that people need to know, what you do is you disclose it in the notes. So examples of this would be if there was a major fire in the factory, right? The value at the year end was the value of the factory, but people need to know that the factory is not around anymore. If you have made a decision to repurchase shares or issue dividends, that doesn't change the equity situation at the year end, but people should know that decision has already been made. Or if you've been awarded a major new contract or entered into a new contract to make a commitment to something, people need to know that in order to evaluate year-end numbers, even though it doesn't actually affect what those numbers are, but it's to do with the interpretation of them. So that's what a subsequent event is. So finally, I want to talk to you about hybrid securities, and these are bonds and preferred shares. A bond is a debt that's issued by the company. From the point of view of the bond issuer, you're specifying some sort of a term, like a 3-year bond and an interest rate. And what happens is that the company pays interest on a regular basis to the bondholder during the term of the bond. And at the end of the term, the company is going to pay the face amount. So what is the price of this? The price is basically the discounted value of each of those future cash flows. So just like we did the present value calculations before, by discounting them, you have a certain set number of interest payments that are going to be made, and you've got a lump sum payment at the end for the face value of the bond. And that calculation takes into account the market interest rates and the risk that's involved in the company. A bond from a reputable company is going to be worth more than a bond from a company that might go bankrupt in the intervening time. And therefore, people are willing to pay more for the bond from the reputable company and less for the company that's risky. So the price is going to take all that into account. The idea of a bond is that it's actually a debt instrument that can be traded to other investors, right? There's an active market for bonds, especially for all of the reputable companies like IBM and Microsoft and so forth. Now, what's a debenture? A debenture is a term that you'll see thrown around when people are talking about bonds. It's basically just a bond that's not secured. Oftentimes, when a bond is issued by a company, there's an explicit lien on some of the assets. The unsecured bond that doesn't have any corresponding asset that there's a lien on is referred to as a debenture. So bonds and debentures are accounted for in exactly the same way, but they trade at different prices because a bond that has security attached to it, an asset that's attached to it, is going to be worth more than an unsecured bond because if the company goes belly up, there's nothing specific that the bondholders can claim. Now, the interesting thing about bonds is even though they're just purely a debt instrument, in order to sweeten the pot, oftentimes companies will add features and little wrinkles into the wording of the bond. For instance, a bond might be convertible into shares. Now, if that's at the option of the person who's holding on to the bond, who's bought the bond, then that makes that bond more valuable because if they want, they can convert that bond into shares. If the option is on the company's side, then that makes the bond worth less to the investor because you've got this bond and the company can come along and say, well, we're just going to convert that into common shares and you're not going to get interest anymore. So that makes the bond worth less. The idea that something is convertible can be either at the option of the bondholder or at the option of the company. There's also what are called call and put options, and I'm never going to expect you to remember which one is which because I can't remember. But basically, in the one case, the company would have the right to pay off the bond instantly at its option, and the bondholder would have to accept that money and forego any future interest payments. So obviously, that makes the bond worth a little bit less because you're not guaranteed you're going to get those interest payments. The company could just cancel the bond and give you your money back at any time. Now, if the option is on the part of the bondholder, then that makes the bond more valuable, because if the company is going into a bit of financial distress and you're not sure whether you're going to continue to get those interest payments, you could demand your money back. So you've lent money to the company, you can demand it back. And that little feature makes the bond a little bit more valuable to you. Preferred shares are an instrument where the company is issuing a share and promising to make not interest payments on it, but dividend payments. Now, there's lots and lots of features that can be built into preferred shares, and some of them make the preferred share seem very much like a bond. And in other cases, those features might make it seem a little bit more like equity. So you can imagine all the features that might go into this. For instance, the company might have the right to cancel the shares and give people their money back. The company might have the right to convert those shares into common shares at its own behest. The shareholder might have the right to convert those preferred shares into common shares if they want. All of these things are going to affect the value of those shares as they trade on the stock market. A preferred share will specify a dividend, so it might be a certain amount of money per share, or it might be a percentage of what's called the par value, which is the face value of the share. The par value has nothing to do with the amount that people actually paid for it, it's just the face value. But dividends on preferred shares are not like interest on bonds. It's not enforceable. With a bond, the company has a legal obligation to make those interest payments. With a preferred share, it could decide, well, we don't have the money to make those dividend payments. And of course, the company doesn't want to do that because it makes the shares go down in value and it makes the shareholders distrust the company, and the common shares might go down. Why? Well, because canceling the dividend payments is likely because the company ran into financial difficulties. It's terrible news for everybody if they don't pay the dividends, but unlike bonds, they can get away with that. The one thing about the word preferred that you need to know is that preferred means that it's preferred over common shares. So if a company wants to pay dividends to its common shareholders, it must pay the dividends on the preferred shares first. So that's what the word preferred means. One thing that preferred shareholders also get is that if the company winds up, the preferred shareholders have a certain amount of limited access to the assets in order to get the value of their shares back before the company is wound up. And it's only what's left over, those residual assets, that are available to the common shareholders. Also, preferred shares don't normally have voting rights. That's what common shares are about. What are these features that preferred share might have? Cumulative as to dividends, meaning that the company has to pay all of the back dividends before it can pay any common shares. They might be convertible into common shares. They might be redeemable at the discretion of the company or retractable at the discretion of the shareholder. Those two things just mean that the shares can be canceled either at the discretion of the company or the shareholder. And there's also the possibility that a preferred share might be written so that it promises a certain minimum dividend, but you might get additional dividend if the company turns out to be very profitable in a given year. Obviously, that's going to make that preferred share a little bit more valuable than a share that didn't have that feature. All of these things affect not only the accounting for the preferred shares, but the value of them as they trade. So the question then is, which of these features that you're looking at here make something seem a little bit more like debt or a little bit more like equity? If something gives you, for instance, the right to participate in excess profits, well, that makes that preferred share seem a little bit more like a common share, doesn't it? And if it is cumulative as to dividends, that makes it seem a little bit more like a bond, because although the timing of the dividend payments is not laid in stone, the company is obliged to make those payments at some point in time if it ever wants to make payments of dividends to the common shareholders. So that legal right that the shareholders have to those dividends makes it seem a little bit more like a bond, so a little bit more like debt. This is one of the key questions about these hybrid securities, bonds, and preferred shares. Are they liabilities or are they equity? So if you look at this situation, there's certain things that are very clearly liabilities, right? So all the current liabilities and long-term liabilities like mortgages, they're very clearly liabilities. And there's some things that are purely equity, like common shares and retained earnings. There's no question those are equity. It's these things that are in the middle in this gray area. So if you've got bonds that could be converted into common shares, well, that's not purely a debt instrument. That's a little bit like an equity instrument. And preferred shares, as we saw, could have features that make them a little bit more like bonds or a little bit more like common shares. So how do you classify these things? That's the key question. If you classify those hybrid securities, and again, it depends on the specific features of the specific hybrid security that you're talking about, but if they're a little bit more like equity and you classify them as equity and put them in the equity section of the balance sheet, that's creating the picture of a lower leverage situation. And if you are able to interpret the features of those bonds and preferred shares as if they're a little bit more like long-term debt, then what you're doing is you're classifying those in the liability section, and that creates a situation where it looks like you've got higher leverage. So the features that are built into hybrid securities are subject to interpretation. Are they liabilities or are they equity? The amount that's going to be shown on the balance sheet is going to be the same either way, but where are they going to be showing on the balance sheet? Are they going to be showing in the liabilities section or the equity section? That's going to change the perceived riskiness of the company in terms of its leverage. And so, to sum up this lengthy discussion of long-term liabilities, here's what we covered. We went over the fundamentals of long-term liabilities, the time value of money and leverage. We looked at some basic debt accounting for loans and interest, recalling that interest has to be accrued, whether it's paid or not, and that's the expense. And the proceeds and the repayment of loan principals have nothing to do with the income statement at all. That all happens on the balance sheet. We talked about notes payable and the implications for that payment that has to be made in the future. And then we talked about the various kinds of debt that have matching assets. So a mortgage on a truck or on a factory, lease payments, long-term lease payments, and pension plans where you've got pension assets versus pension obligations. We talked about all those miscellaneous obligations like provisions, contingencies, and commitments, and then that category of subsequent events, which is not really an obligation, but it's one of those things that needs to be disclosed in peculiar fashions. So I threw it into this section just for the sake of completeness. And then we talked about hybrid securities, bonds, and preferred shares. I did not get into the accounting calculations for bonds and preferred shares because that's beyond this course. But the important thing to realize is that they behave a little bit like liabilities and a little bit like equity, and you have to decide where to classify those, and that's going to affect your leverage calculation if people are looking at your balance sheet and trying to determine the riskiness of the company. So that's long-term liabilities.
Well, it's all about money, money, money. Ooh, money, money, money. Ooh, yeah. Dollar signs in your eyes. You only wanna make yourself